So dividend investors are probably not going to enjoy hearing this, but you will likely not outperform the S&P 500 by investing in dividends. Now, before I get too much criticism, I do want to say that I am a dividend investor myself. I do have a significant amount of money in popular dividend funds like SCHD and VIG. And I also have a significant amount of money in popular growth dividend fund, the Vanguard Dividend Appreciation ETF or VIG. But I do think it's important for dividend investors to understand why dividend investing will not outperform the S&P 500 and why I think that is okay if you understand what dividends are and how they can reduce the volatility of your portfolio. So the first thing is to understand what a dividend is. Simply put, a dividend is a distribution of the company's earnings to its shareholders, and it is determined by the company's board of directors. So dividends are often distributed quarterly and may be paid out as cash or in the form of reinvestment through additional stock. So that is like DRIP through dividend reinvestments, or it's through cash. So as people buy products of the company will retain this revenue that the company earns through selling its products, and then from that revenue, the board of directors will decide to distribute that in the form of a cash dividend. So an example of this is the extremely popular dividend company Coca-Cola. This company has been paying out dividends for decades. And if we look at the dividend history, you can see that it pays out currently 46 cents every quarter, and it generally grows over time if the company is in the dividend growth distribution part of its life cycle. Now, when Coca-Cola earns money, it decides to take some of that money it earns and pay out its shareholders this 46 cents per share. And a dividend is a quality mostly of well-established companies. Basically, companies that are growing their revenue or they're just growing in size, whether that be they're new or they are possibly running on debt. They want to use all the money they have to grow their business operations or pay off their debt generally, and they don't want to pay that out to shareholders. In fact, many companies do not pay dividends, and instead they retain the earnings and reinvest it back to the company. In other words, when a company pays a dividend to you, they're just not using that money to reinvest into the company. So a company like Coca-Cola instead opts to pay out its shareholders instead of reinvesting back to the company, because the company's board of directors doesn't believe that Coca-Cola itself really has that much growth to provide by reinvesting that money back into the company itself. So this is kind of an example of a company that pays out a dividend instead of reinvesting back into the company. So over the past 5 years, Coca-Cola grew its share price by about 16%. Now, again, a lot of that money was paid out in dividends, the money that they earned, instead of reinvesting it back into the company. Now, instead, we look at PepsiCo, which is somewhat similar to Coca-Cola in their business operations, and the company also does pay a dividend. However, they did not maintain such a high dividend as Coca-Cola over time. And we see what happened to the share price. It increased a decent amount versus Coca-Cola. So this is just one example. It kind of just goes to show that PepsiCo outperformed Coca-Cola when it comes to share price over the past 5 years. And part of that is because instead of paying out that dividend, they reinvested back into their company to grow their core business operations. What happens if you take a group of dividend stocks and then compare them to the overall S&P 500? So I have the Schwab US Dividend Equity ETF, or SCHD here, and basically this company invests in pretty high yielding dividend stocks and then further filters them by financial ratios. So what it gets is kind of the best of dividend stocks. Now, just to show you an overview of its holdings, we see a broad array of dividend stocks, and we even see both the companies that I spoke about before, Coca-Cola and Pepsi, and among others diversified by industry. And then I also brought up VIG, which is another popular dividend ETF that's focused on dividend growth instead of just high yield dividends. So the way this fund operates is that it invests in companies that have a track record of growing their dividends over time, and I believe that is 10 years or so. The company needs to have grown its dividend for 10 years consecutively to be included in this screening metric. So I'm going to go down and show you some of these holdings, and we can see that this is also very diversified and probably even more so than SCHD. And we have a broad array of companies here, everything from tech to energy to financials. So how do these companies compare against the S&P 500? So I brought up the page for SPY, or the Spider S&P 500 ETF Trust. This is an ETF that basically just tracks the S&P 500. It doesn't really get any more simple than that in the investment world. And we see its holdings here are very tech heavy. We have Microsoft, Apple, Amazon, Nvidia, Google, Facebook or Meta, Berkshire Hathaway, Tesla, and United Health. Now, some of these companies do pay dividends. However, they're not really dividend companies. They just are an added benefit. They pay it on the side. And these companies don't pay high dividends. Like Facebook doesn't pay a dividend at all. Neither does Nvidia, and neither does Amazon. Google doesn't. Tesla doesn't. And I think you get the idea. The S&P 500, especially at the top, is not a dividend performing ETF or index. So how do these funds or indexes perform head to head? So I basically pitted all them together on Portfolio Visualizer. We have SPY, the ETF that tracks the S&P 500 index, SCHD, the higher dividend yielding ETF with financial ratio screening metrics, and we have the Dividend Growth Fund VIG. So this is a result from January 2012 to current, and this is done that way because some of these ETFs did not exist prior to January 2012. So head to head, I think we can see the comparison, how the S&P 500 defeats both these dividend ETFs head to head. And it kind of just goes to show you that over the long term, the S&P 500 does outperform dividend ETFs. And here's the chart of that performance over time. And I also want to do something else because I want to dollar cost average instead into this and see if the result changes at all. So I did an initial investment of $10,000 and left it the same. So let's see if that result changes if we contribute a fixed amount, and let's just say we invest $100 a month, and let's not adjust for inflation, and we will contribute monthly. And let's see if that changes our metrics at all. Let's see how the funds compare with that result. So portfolio 1 was the S&P 500, and it still outperforms, and the other two trail by a decent margin. So interestingly enough, though, if you notice, there are times when the fund SCHD did outperform the S&P 500, and that's because dividend companies and other companies that comprise the S&P 500 trade differently. The S&P 500 is very tech heavy, and the fund SCHD is much more diversified. So a few months back, we had a time in the market where tech companies were greatly affected. So of course we would see tech companies drop significantly versus the remainder, and we saw that SCHD began to outperform the S&P 500. So it's very important to notice that although it does look like the S&P 500 will outperform over time, it doesn't always have to be that way. And if we look at other metrics, like if you're a risk-adverse investor, you'll see that the worst year the S&P 500 was 18%, whereas these dividend funds, you were down significantly less, even like half as much. So you would have seen your portfolio drop even less. So in the good years, it might seem like a great thing, but in the bad years, it's going to be awful. So we do see similar best years and similar max drawdowns, although these dividend ETFs did have a lower max drawdowns and they had slightly smaller best years. And actually, I think SCHD had a better best year. And we see that these funds are not completely correlated to the market either. So they will rather perform a little bit differently. And this is how the performance of these ETFs look as a bar graph. We do see some years where SCHD does outperform the S&P 500, and we see years when the S&P 500 performs quite a bit better. And it's also important to remember that these returns do not reflect the taxes that you will have to pay on the dividends if you do hold these funds in a taxable account. So that will further drag on this performance as well. And some people even argue that dividends are irrelevant because if a shareholder wants money, they could simply sell the company's shares that they own to receive funds instead. So instead of having that dividend paid to you quarterly, you can just sell stock as it grows. So with all that said, and I said before that I wasn't a dividend investor, if dividends don't really matter and they don't perform as well over time, why do I invest in dividends? And I think that the asset backtesting portfolio speaks to itself. I am more of a defensive investor. I don't like my portfolio to have a lot of volatility. I am okay with slightly decreasing the amount of growth over time instead of getting these large max drawdowns. It's also nice not to have to worry about buys and sells and to get those dividends paid to me over time. And I also do like the fact that a lot of these dividend companies, or ETFs rather, grow their dividends far more than the S&P 500 does. So later down the line, I will get a better yield on cost for my money. And to kind of counterbalance the companies that are invested in dividends or dividend companies, I do hold a decent portion of money in QQQ, which is a NASDAQ company. I mean, the NASDAQ, it just tracks the NASDAQ index. And I have about $14,000 invested in that. And these companies are all growth companies. So it does a little bit of a counterbalance. And if I want to go more growth orientated, I only have to increase the proportion of the holdings that I have. So it's dedicated to about 30% of this fund. And overall, I think I have about 18% or so invested in QQQ, which I believe is more of a growth fund. So that's going to be it for today's video. I thank you all for watching, and I hope that I gave you a decent overview of how these ETFs and dividend companies perform relative to the S&P 500. Maybe you already knew some of this information, or maybe you're new to investing and you're looking into dividends or the S&P 500 or growth companies or value companies, and you just want some more information, so you decided to watch this video. Either way, again, I appreciate you all for watching, and I'll catch you in the next video. Thank you all, and have a great day.